Hey, I'm Ben from Modern Graham, and today we are going to talk about Prudential Financial Inc. We're going to do a Modern Graham valuation, so be sure to stick around and see what I think of this company. So first up, we have Prudential, of course, and the ticker is PRU. The current price is 98.26. The sector is financial services, and the industry is insurance. Down here, we have the items from the balance sheet that I find to be most important. We have the total current assets, the total current liabilities, the long-term debt, the total assets, the intangible assets, total liabilities, and shares outstanding. And all of these figures will come into play in this valuation. Over here, we have the chart that shows the earnings per share diluted in blue. You can see that going up, and then it took a hit around the financial crisis. It came back up a little bit, and then it took another hit in the early 2010s, and then it went back up, and it took another hit in the pandemic era. Yep. So anyway, and then red is dividends per share. You can see that has pretty much gone up. It did have a little break, and we'll look at the raw detail here in just a moment right now. Earnings per share diluted, you can see we are looking at about 20 years of earnings data here, and we have 3 years out of that where the earnings were negative, and it has been up and down a lot. But over here we have the earnings per share MG, earnings per share Modern Graham, which is a weighted average of the last 5 years of earnings, putting the most weight on the current year and the least weight on 5 years ago. And we do that because it helps to smooth out the business cycle, to try to help you see overall trends in the earnings. And for the most part, I mean, that has totally stayed positive the entire time. But for the most part, it has been going up, or no, it actually has been rather flat at times. The recent years, it has been up, but when you look at back here, all of that is pretty much flat, and then flat again in there. So there hasn't been too much movement there, but we'll see how it comes out in the valuation in a little bit here. Dividends have been positive for all of the years. They've paid dividends the whole time. They only had 1 year where they cut the dividend. That was 2008. And most years they grow them by 10 to 20%. Dividend yield, 4% is pretty good, and that is higher than it was before. Dividend payout ratio, that has been all over the board, but that shows that they are really putting an emphasis on that dividend to make sure that even though their earnings are fluctuating, they're still paying that dividend. And that's one thing that you like to see if you like dividends, like me. Now, stage one, is this company suitable for the defensive investor or the enterprising investor? And remember, the defensive investor is one who is not willing to do a lot of research into individual companies. So they have a stringent set of requirements that companies must pass. First of all, we have the size must be over 2 billion in market cap. This one is 36 billion, so we pass there. The current ratio has to be over 2. This one has a very solid current ratio as an insurance company. And then the positive earnings per share must be for 10 years straight. We only get 9 or 8 out of 10 here because they had negative in 2020 and negative in 2013, so that is a fail. Dividend payments for 10 years prior, it passes that. Earnings per share increasing by 33% over the past 10 years, it passes that. And PEMG, that is the price to earnings ratio using that weighted average earnings per share MG, and that comes to 12.77, which is less than the defensive investor's requirement of 20, so we pass that. Price to book ratio of under 2.5, we are at 2.2, so we pass that too. If you've been keeping count, we've got 6 points here. It is suitable for the defensive investor. Now, by default, it is then suitable for the enterprising investor as well. Remember, the enterprising investor is one who is willing to do even more research into a company, so their requirements are not quite as stringent. So we have a pass here. Now, take a moment to like the video, subscribe to my channel, and download the free valuation calculator down at the bottom in the description and the comments below. Stage 2 is a determination of intrinsic value. Now, this one is interesting because value we get by taking value equals earnings per share modern gram times 8.5 plus 2 times the growth rate. That formula comes from Benjamin Graham's book, The Intelligent Investor, but I've updated it to have that weighted average earnings per share in there. And we have two variables here that are very key to determining value. We have earnings per share and growth. So let's calculate those. Earnings per share, again, is a weighted average of the last 5 years of earnings. So we come to 769, plug that in for growth, and we take the same figure from 5 years ago, and we can see that it has gotten smaller. Total growth is negative 34%. Divided that by 5, we're averaging a shrinkage of 6.86% per year. We put a safety margin in there. We don't think that a company will have such extreme growth figures in either direction at any point in time in perpetuity. And so we have a safety margin there. And the growth estimate is capped on the negative side at negative 4.25%. And that is because if you have any growth, any worse growth than that, you end up with a value of less than 0, which does not make any sense. So here we have come to a conclusion that the value is currently 0 based on this formula. Then we have to look at a few other things. We can look at the net current asset value, which is a liquidation value, but that's negative 2, so that doesn't quite work. If we assume 3% growth in perpetuity, we get a value of 111.56. If we look at 0% growth, then the value would be $65.40. So if we assume that they're not going to shrink any further, then that would be the value right there. If you want to see what the market is implying, you put price up here for value and then solve for growth, and we get a result of 2.14%. So that's another way to look at value. If you think that the market is implying a growth rate that is less than what the company will achieve in perpetuity, then you would decide that this is undervalued. If you think that growth rate is higher than what the company will achieve, then it would be overvalued. And then here we have our handy chart, which today is particularly useful. We have the current price, and then we have 0 for the value. Over here, you can see that that means it is overvalued, obviously. But let's look at the grade. So the grade takes into account more than just that value formula, because, you know, Warren Buffett says that he'd rather buy a great company at a fair price than a fair company at a great price. So there might be more to consider in terms of the company. So we have investor suitability. It is suitable for the defensive investors. So we get 2 points there. It is not a good price to value. So we get 0. It's not trading below its gram numbers. So we get 0. It's not had long-term dividend growth. So we get 0 there. But it does have a dividend yield above 2%. So we get half a point there. It does have a PEMG below its industry average, so we get half a point there. And overall, then we get to 3 points. That gives us a B- grade, which is a, it's a passing grade, and it is okay. Now, moving on to stage 3 is further research. If you have gotten to this point and you've decided that the company is suitable for your investor type and the price is something you're willing to accept, then it would be time to do further research and look into other things to determine if this individual company is suitable for your particular investment type. Now, and your portfolio. The net current asset value, again, that is a liquidation value. It's a floor. It's a negative here. That doesn't really apply then. The Graham number formula is derived from the defensive investor requirements. And people have come up with this over the years to have a easy way of looking at Benjamin Graham's requirements to turn it into a number and make it easy. And here we get a Graham number of 46.29, which again is higher than the price, so it doesn't indicate an undervalued situation. The PEMG again is 12.77. The current ratio is 304.55. The PB ratio is 2.2. The dividend yield is 4.9%. And the number of consecutive years of dividend growth is 15. Moving on to stage 4. This is when you want to look at the chart, because even though we don't want to pay attention to what Mr. Market is doing in terms of how to value the company, we do want to look to see if today is a good time to enter a position. So that can play a role with technical analysis in your decisions, because it can help you maximize your profit. There is some value in doing this. Now, we can see on the daily chart here, these red lines are resistance levels that the company is likely to see on its way up, and green is support levels that the company is likely to see as well. You can see that right now, the company is kind of bouncing around a support level here at 98.26 approximately. I mean, technical analysis, your numbers are never going to be exactly right. But here, you can see that it is bouncing there. If it were to fall below that, it might come down to 91 before hitting another major support level. Or it might come up to 105 and then have a little bit of trouble getting higher there. And then there's another one shortly after that. And so this is a pretty tight range that it might be in. Down here, you can see the relative strength index, which is the momentum on the stock. And you can see that it dipped way down and was almost oversold, but not quite. Back here in September, it was more oversold, and you can see that it came down. And did it go under 30? It did very briefly here, the end of September, which indicates that it was very much oversold there. And then up here, it was overbought in the end of October, but you can see that it really rose up from end of September. It was at 85.78 at close, and end of October, it made it up to 106 at close before it started to be overbought. So it did have quite a range there. And then here it has kind of just leveled off there. If we look at the weekly view, you can see this even more. This goes back farther. And you can see where these lines came from. We had a little bit of points here where it was hitting that, and which also corresponded to back in 21 a little bit. And then here, this one hit a few times. Up here, this has hit several times, and here as well. And then there are more farther up if it does get above that. But you can see that the RSI, up here, it got way overbought. It had been on a tear from March of 2020, which corresponded with the start of the pandemic, of course. And then out here to June of 21, May or June, it was on a big rise, and now it's been coming back down a little bit. The red line here in RSI is the shorter moving average, and the blue is the longer moving average. And those have kind of come together, so we might be seeing a turnaround soon where that momentum might be coming back. But it will be interesting to see what it does there. But anyway, that is what you want to look for here. And yeah, be sure to click on the screen now to go to another great valuation that you will find useful. Thanks for watching, and I will catch you next time. Take care.